Hi, good evening, everyone. Thank you for taking the time to join us for today's webinar. The topic tonight will be, what does COVID-19 mean for the future if you are a bond investor? But before I pass the time over to our speaker, let me begin by giving a short introduction to iFAST Global Markets, or IGM for short. IGM is a division of iFAST Corporation, which was listed on the Singapore Exchange in December of 2014. We are backed by a very strong team, ranging from our operational team that ensures smooth account opening as well as transactions are performed seamlessly. We also have an investment research and content team that provides timely updates on the market as well as product developments to aid our investors in the investment journey, and also not forgetting our IGM advisors who are capable in developing and reviewing portfolio recommendations for our clients. We also are an all-in-one platform with, we cover most of the major products such as unit trusts, bonds, stocks, ETFs, DPMS, or our discretionary portfolio managed service, as well as insurance. At IGM, we also have platforms that are suitable for everyone. No matter whether you are a DIY investor or you require financial advisor's assistance, you can get started with us. Okay, with the convenience of the internet and our in-house technology, you're able to monitor your investments, account statements, or view investment-related information through our secure website or mobile app 24/7. Okay, so as what I mentioned earlier, at IGM, we have the flexibility to choose to invest in DIY or through an advisor-assisted account. Okay, so this evening, if you have any questions, type it into the Q&A chat and we'll answer them at the end of our presentation. For other questions that you may have, do reach out to your friendly IGM advisors, or for those of you who are new, you may contact us via email or give us a call. Okay, so with that, we'll begin tonight's webinar. Okay, so today with the coronavirus outbreak affecting Singapore and other countries around the world, local governments have deployed containment and lockdown measures that are likely to put the global economy into a severe contraction. And the dire outlook led to a plunge in financial asset prices. As a result, investors fled from stocks and corporate bonds to cash and treasuries, resulting in global equities and corporate bonds seeing their worst quarterly performance since the GFC in 2008. In such trying times for investors, we have today Mr. Ang Chung Yuh, who will share his views on the ideal course of action for long-term investors in such a market environment, while also highlighting factors and ideas that bond investors could consider. Chung Yuh is the manager of the fixed income division at bondsupermart.com. Prior to joining the company in August 2017, he was the assistant fund manager and held various investment and compliance roles at Phillip Capital Management between 2014 and 2017. He started his career as an officer with the HSBC Group before moving to Risk Management Institute between 2010 and 2014. At the moment, he leads iFAST fixed income research function in providing credit analysis and bond recommendations. Chung Yuh also holds the Chartered Financial Analyst designation. Okay, so with that, I'll hand over the time to Chung Yuh.
Hi, Lisa. Are you able to see the slides now?
Yes.
All right. Okay, good evening, everyone. My name is Chung Yuh, and thank you again for joining tonight's webinar. I think first of all, I have to say, obviously, these are normal times we are in, and I hope you and your family are safe and well during this lockdown period. So my presentation tonight is basically based on an article I wrote a couple of weeks ago, which talks about the current market environment, some of the things we know about the situation, some of our guesses, and what we think is impossible to know. The article also highlighted a few of our favorite bond ideas after the sell-off. And I've also thrown in some additional content for this presentation to express my gratitude for your joining us tonight. So I'll start with some facts about the current situation. I think both equities and bonds saw their worst quarterly performance in the first Q since the 2008 global financial crisis. And obviously the sell-off was in response to mandated lockdown measures imposed globally, because these containment measures are equivalent to putting our economy into a coma. And nobody knows how fast the economy can restart after this, and how soon can it return to pre-crisis level. But I think the more important question for all of us is, after the sharp decline in financial asset prices, has the market become cheap enough, even if with the expectation of a recession? I'll try to answer that later. I'll look at the volume of new bond issuance as an indicator of investor sentiment. And broadly speaking, new issue volume in Asia has slowed to a trickle starting in March. So for Sing dollar, the new issue volume since March was the lowest since GFC. I take this as a sign that the risk appetite in Asia is very low, which is usually a good thing because we should be more aggressive when the market is scared and things are cheap. Another fact about the current situation is that obviously the world economy will be going into a recession this year. The chart on the left shows some of the early pain we have seen with both China and Singapore economy shrinking significantly in the first quarter. For China, I think it was the first ever contraction since they started to report GDP. And IMF projection, as shown on the right, are telling us that the world economy is likely to go through a recession at least as bad as 2008. So a frequent question that I've seen is that what is the exact impact on GDP this year? How long will the recession last? But unfortunately, my opinion is that nobody has the correct answer to these questions. We are looking at one of the greatest economic contractions in modern history, and along with unprecedented government and central bank stimulus, as well as the greatest oil price decline ever. So I think it's impossible to predict how these factors will interact with each other. And if I'm experiencing something that's never been seen before, I think I simply can't say I know how it will turn out. But one thing we know for sure is that with the economic recession and the associated pressure on companies' cash flows and earnings, corporate default rate will climb. So all big three rating agencies have forecasted higher default rates. For Moody's, they expect the default rate of high-yield issuers to rise to 6.8% if the downturn is sharp but short, and potentially 20.8% if we experience a recession that's more severe than 2008. Next, as I mentioned earlier, governments worldwide have announced an unprecedented program of stimulus, support, rescue, and regulatory relief. And I highlighted some examples here. Just now, I've said that the global lockdown measures are equivalent to putting the economy into a coma, which has never happened before in our history. So we can look at these stimulus packages as life support for the patient so that the economy can bounce back after the shutdowns are lifted. Another one of the few things that I'm sure of is that prices of financial assets are a lot lower than pre-crisis level. The current financial market turmoil has wiped out years of gains in a matter of weeks. So from a fixed income market perspective, credit spreads on corporate bonds have widened significantly, especially for high yield credits as shown on this slide. What this means is that investors are getting paid a lot more for taking on credit risk. And moving on to some of the things that I don't know. So firstly, when will the world be able to get disease under control and for people to get back to work? How many people will the virus infect and kill? You probably have seen many estimates from different scientists, and I think their predictions can be very different from each other. But anyway, I've listed some examples here. But in any case, even if we assume that all our shutdowns are lifted tomorrow, will any one of us immediately go and take a flight? And how will we react when we go back to work and one of our colleagues cough in front of us? Also, will we prefer to eat at places where our waiters wear masks? I think questions like this suggest that even if our government remove the quarantine, let's say tomorrow, we probably won't return to our former habits immediately. So I think the opening of the economy is likely to be gradual and in phases. Next, with central banks and governments racing to deliver stimulus, are these measures enough to prevent the economy from unraveling? I think it's still too early to have an answer for that. And I think the effectiveness of economic measures will vary a lot by country. So if we take the US as an example, the graph on the right here shows that previous rate cutting cycle goes about 500 basis points, meaning the government will cut about 5% for each rate cutting cycle. So in March, the Fed cut about 150 bips only, and I think that's likely to be lesser in its impact. Also, even if the governments can simulate the effect of the economy by, let's say, writing everyone a check for as long as the shutdown measures are in place, we still need to produce the actual goods and services that money buys. So just like there will be side effects if a patient is put into coma for too long, I think there's also likely to be an impact on the world's productivity if we stop functioning for a prolonged period. And next is the million-dollar question. Has the market bottomed? My own view is that just like any other market crash, it is impossible for anyone to know whether markets have bottomed. For us to guess correctly, we not only need to predict when will the disease be under control, how fast can the economy restart, and also how investors will react to all the news that appear in the meantime. But if you ask me, my own guess is that we are unlikely to have already gone through the bottom of the current market crash, especially for the US market. So as shown on the chart here, I'm using US as an example. Although declines in the US stock market have been sharp, almost all of the downward movements were followed by substantial gains. In fact, global equities just had the biggest monthly gain since 2011 in April. And that even with slowing earnings growth and severe GDP contraction. So I see that as a sign there's still some optimism in the market. But nevertheless, I personally don't invest based on whether I think markets are at the bottom. I prefer a more reliable approach, which is to think about whether I can assess value cheaply at current prices. That means the question I ask myself is whether I'm getting paid well in terms of the future cash flows for my investments relative to the price that I'm looking at. And moving on to some of my guesses, there have been many comparisons between COVID-19 and the Spanish flu. But I think it is unlikely that COVID-19 will take over the title of the deadliest pandemic in modern history. I like this picture here because I think it provides a good visualization of pandemics in their death toll. So Spanish flu is the big green ball on the top row, and COVID-19 is the tiny circle on the bottom row. And my wife is a doctor, so she always disagrees with me when I talk about this kind of statistics because she feels that I'm downplaying the severity of the situation. But I'm actually not, because I agree with the medical experts that COVID-19 is a new virus and a huge threat because our world is now vastly more populous and interconnected than before. But then I'm a financial analyst, so it's my habit to put things into context, which is what I think this picture does. And more importantly, even in the case of Spanish flu, which killed more people than World War I, it did not decimate the business world, and the economy and the global economy eventually recovered. Although I said earlier that I believe nobody knows whether markets have bottomed, I think current valuations are telling us now is a good time to invest. It may not be the best time because, like I said earlier, prices may very well move lower, but I don't have the ability to predict market movements. So I can only recommend to buy when we see bargains. And I think there are certainly a lot of opportunities in the market today, especially in Asia. Like for instance, Asian high yield, their credit spreads are now, I think, around double digits. So if someone buys a diversified portfolio of high yield bonds at current prices, I think it will take a lot of bad things to happen for him to suffer large losses. So this chart here shows the historical default rate of Asian high yield bonds. And even if we take the worst case scenario of Moody's, which is that we will see the default rate jumps to 21%, which never happened before, by the way. Defaults at that record level have to happen every year moving forward, not just a single year, for a diversified high yield investor to lose money. Okay, I will next highlight some of our favorite bonds at this point of time. But before I start, I just want to share with you a quick story because I felt it perfectly illustrates the typical behavior and mindset of an investor. So in the middle of March, my boss texted a client to let her know that there's a bond yielding around, I think, 7 to 8%. And it was previously yielding just about 2% before the virus happened. So my boss was asking whether the client would be interested with the much higher yields. The client said no because she thought the bond was trading at a distress level and it's too risky for her. But then in the middle of April, the same client came back to us and asked whether the same bond had any liquidity because she felt it looked attractive at the prices prevailing at that time. But by that time, the price had already went up by more than 15% and the yield was just around 4%. So my boss naturally got curious and asked her why were her not keen when the price was much cheaper. And then the reply came back, which was basically the same because the bond was trading at a distress level and now it is not. I felt that wasn't a logical answer because it meant the client would prefer to buy when things are more expensive. But at the same time, I felt that was also a very common response. There's as much as we want to buy low and sell high, we usually tend to do the opposite in the crash. So most of the bonds that I'm about to highlight in the next section might not have very exciting use, but I focus the least on issuers that have the financial firepower to survive the global pandemic. So investors should be able to remain calm and not sell even when the bad news come in. This first bond is a HSBC PERP. callable in 2022. If called, the yield will be around 7.5%. There have been quite a number of negative headlines surrounding HSBC, and I've listed some examples here. So the headwinds actually started last year when the big three rating agencies all took some form of negative actions on the bank's ratings. That means either downgrading its outlook or downgrading its credit ratings. The downgrades were mostly because of lower earnings expectation and uncertainty surrounding HSBC restructuring plan. And you might also have heard about the bank cancelling this year's dividends. Another factor that weighed for most bankers was that since the crisis happened, a lot more analysts have been highlighting the risk of bank AT1s, like they lack a maturity date, there's absence of step-ups, and the fact that banks can defer coupon payments on this kind of instruments. Although I personally find it curious that there's very few people mentioned about these features before the crisis. I think the 7.5% yield to call is a good reward to take on this risk. Even with the rating downgrades, HSBC is still one of the world's most highly rated banks. Also, it's important to note that the suspension of dividends came after a formal request by the UK financial regulator to all major UK banks, and not because HSBC is in a liquidity crunch. In fact, if you go by its capital ratios, the bank is in a historically strong position. For more conservative investors, I think the DBS USD perp is a good alternative. After I published the article, I think last month, the bond price has went up quite significantly in the past couple of weeks. And the yield to call has now dropped from 6+% to 3.7%. But even at this level, I think it is still a decent yield, considering that the bond was yielding a low 2% prior to the pandemic. So I'm confident that the Singapore banks will be able to ride out the economy recession, because some of the macro indicators, like what I've included here, is the Singapore's credit to GDP gap and the loan growth. They are showing us that the amount of leverage in Singapore's financial system is low. And because of our financial system is very healthy, MAS has said that it does not need to restrict dividend policies of the banks, unlike in many other countries. DBS is also very profitable to the extent that I think even if they provision for 3 or 4 times more impaired loans, I think they will still record positive earnings this year. And unlike UOB, it has a smaller exposure to the SME segment. The next bond is the 4.8% US dollar bond of Press Metal. So this is a Malaysia company, and it is the largest aluminium producer in Southeast Asia. Previously, the bond was trading at around par. That means about 4.8%. It is now yielding 14%. One of the reasons that sent the bond price plunging is obviously the lower expectation for low aluminium demand, or broadly speaking, commodity demand because of Covid-19. And aluminium prices had already been falling even before the crisis, mostly because of the US-China trade war. So we think the sell-off has been excessive, and Press Metal should be able to outperform because of its, mainly because of its cost advantage. So due to its large scale, this company is in the first quarter of global aluminium producers in terms of its cost. That means it can produce aluminium cheaper than most other producers. So we think it is likely to remain profitable even under these circumstances. Press Metal also has adequate financial liquidity from its credit facilities and operating cash flow. This next bond is another US dollar bond of Season Group. Season Group is a residential property developer in China, I think previously known as Futureland. So the main operating subsidiary, Season Holdings, is the number 8 property developer in China in terms of its overall strength. Even if you don't know much about the Season Group, you might have seen somewhere the headlines about its ex-chairman being arrested last July, I think for child molestation. Then the company's stock and bond prices immediately tanked after the incident. But I think the management has responded well, and Season managed to achieve its targeted contracted sales of 270 billion yuan even after the incident. In fact, its balance sheet is now much stronger than before, with its cash alone covering almost 75% of total debt, and its contracted sales are much higher than borrowings. I also like that management has seemed to have taken on a more conservative financial philosophy, probably because they wanted to reduce risk in preparation for the management transition. They've also announced an asset disposal plan last year, which should further improve the company's liquidity position and leverage. This is the 2022 SGD bond of ESR Cayman. This is a logistics property company that IPO in Hong Kong last year. So what I like about this company is that close to 60% of its assets under management are located in China, Singapore, and South Korea, where I think the governments have been relatively more successful in containing the virus. Also because its portfolio is predominantly logistics properties, and more than 60% of its tenants are e-commerce and logistics companies. So far, there has been minimal disruptions to its business. I also like that ESR Cayman generates a substantial portion of earnings from its fund management business, which has higher margins and lower capital requirements. So if I exclude fair value gains from the other segments, I think the fund management business generates about 40% of the company's operating profit. The next bond is from Singapore's largest telco, Singtel. So if you look at the yield alone, 2.6% may not look very exciting. But to put that number into context, the credit spread of this bond is almost double than pre-crisis levels. So we all know that there's a lot of competition in the domestic market, but Singtel is very diversified in terms of its geographic exposure. So its credit metrics have remained strong. And gearing as measured by both net debt over equity and over EBITDA is very low, and interest coverage is high. Their liquidity position is also comfortable, with around Sing dollar 3.6 billion of free cash flow expected in the current financial year, including dividends from regional associates. The company had around 3.3 billion of short-term debt, and it recently raised more than 4 billion of credit facilities from its banks. I think partly because it wants to have a buffer against COVID-19, and partly because it probably hope to have funds in place if it sees interesting acquisition opportunities in the market because of low prices everywhere. The last bond idea that I'll talk about is the 2022 SGD bond of Olam, yielding about 5.7%. So this slide shows the substantial shareholders of Olam, which is one of its primary credit strengths, because it has Temasek as the biggest shareholder at more than 50%. But previously, we have rarely recommended any Olam bonds because I personally felt that the market was pricing too much of a premium for it being a Temasek-linked company. And I felt the yield was quite low relative to the company's financial health. So you might be wondering, why do I like this bond now? Mainly because I think the bond price has plunged and the yields are now much higher than before. So I think the bond now gives a good use for Olam's food and agricultural business, which should be resilient in this downturn. Olam also has good financial liquidity with more than 9 billion of unutilized bank lines and 3.2 billion of cash. Short-term borrowings were around 7 billion, and I think only around 250 million were bonds. Plus, the company has very strong access to bank funding and have built various channels like, I think, sustainability-linked and digital-linked loans. That means its access to bank funding is very strong. So Olam's net gearing was stable last year, even though the application of new accounting standards added about 400 million of lease liabilities to the balance sheet. The company has plans to sell assets and release cash of up to US dollar 1.6 billion, out of which they have already achieved 488 million Sing dollars so far. And that's it for my presentation. Again, thank you for joining us. I think Kezia will move straight to Q&A, right?
Yeah, that's right. So if,
Okay,
anyone who has questions, please type it into the Q&A chat and we'll answer it. Okay, yeah, Chung Yuh.
Okay, I'm trying to look for the list of questions. Okay, well, I have one question so far from a participant asking about if USD skyrockets, will that increase the defaults in the high yield Asian bonds? broadly speaking, I think yes, but I think there's a smaller concern for the Asian market. I think that's more of a concern for emerging markets. For Asian high yield, I think a big part of that is in the Chinese property sector. A lot of the issuers there, including those double B or single B, I think their liquidity and their sales so far has been very strong. I mean has been relatively resilient even in the face of the COVID-19. And after the government lifted the restrictions in terms of the workplace restrictions and the traveling restrictions, I think so far we have seen more than 80% resumption in their construction activities. So I think the Chinese property developers should have enough cash collection from the pre-sales and also from the handovers to meet their debt obligations. That's broadly speaking. Of course, individually we need to understand the liquidity situation of a specific bond issuers. If there's only one bond to buy from your recommendation, okay, I'm looking at the next question, which is participant asking if there's only one bond to buy from my recommendation, which one is the most value for money to buy? I think it depends on whether you are a high yield whether if you are a high yield investor, whether you are more aggressive or you like to be somewhere. I mean, you try to reduce or be more defensive in this current environment. So if you like to reach for higher yields, but at the same time want to keep your exposure manageable, I think bank AT1s like the HSBC I mentioned is a good choice. A riskier choice that I think provide very good value for money is the precious metal bond and also the ESR Cayman bond. Like I mentioned earlier, I think ESR Cayman so far has seen very minimal disruptions to its business because its clients, a lot of it is e-commerce companies, and you probably are aware that their sales are actually stronger during this period. And at last check, I think of a few hundreds of the properties, less than 10 are closed at the moment. So I think I expect very minimal disruptions to the earnings moving forward. Will bond funds be, next question is, will bond funds be better or are straight bonds better? Since you mentioned that high yield is attractive at current. So I've seen this question quite frequently. I think there's no one answer there's no one blanket answer to be correct for everyone. I mean, it depends on your needs. That means if you need to have close control over your cash flows, whether you are expecting cash needs in a specific amount of years, and that means in that case your obvious choice will be bonds because it allows you to have control over when the cash flows will come in, and you have a direct visibility into the amount of coupons you receive and when you will receive your principal. But let's say if you agree with me that high yield bonds are right now very attractive, and then by the same time, my recommendation is usually for people to at least hold 5 to 10 bonds. And actually, even that is quite concentrated. But if you are unable to achieve a diversified portfolio, because defaults will definitely climb, so it's important for you to have a diversified portfolio. But if you're unable to achieve that, then I think investing in a bond fund would be a more reasonable or a better choice. Is there a minimum sum required to buy any of the recommended bonds I mentioned earlier? I think most of them, except for Singtel, is on our list of Bond Express bonds. So what Bond Express allows our clients to do is that accredited investors can buy into these bonds at smaller sizes, I believe at $5,000 sizes. But if you're not accredited investors, then you have to buy this bond at their wholesale convention trade sizes. Is about 250,000 Sing dollar or 200,000 US dollar. What is my view on foreign banks perps such as SocGen, UBS, SCB, CS, etc. Given the potential non-performing loans, what is the risk of the coupon or default? Okay, I think I'll answer the first question, which is what is our overall view on the foreign bank perps? So you mentioned 2 Swiss banks there. I think for Swiss banks generally, their results have been relatively very strong in the first quarter. Partly because of market trading activities. meaning because the market has been very volatile, so their market trading activities has been profitable. So that helps in terms of the income. But at the same time, I think so far all or almost all the banks that reported first Q results have seen significant increase in their loan provisions in preparation for the likely economic impact from COVID-19. But for the views on the bank perps, which is your second question, given the potential increase in non-performing loans, what's the risk of the coupon of default? I think the risk of outright default is very low. And I think the risk of conversion, because if you're talking about perps, they have and you're talking about European perps, they have the risk of getting converted into equity, which is why they are called COCOs. I think the risk of that happening is very low. The capital ratios of most banks, not every banks, but most banks have been significantly stronger if you compare them to the last financial crisis. So I think the risk of their capital ratios falling down to the trigger level is very low. But if you're talking about the risk of coupon suspension, then because the banks are allowed to suspend coupons on these AT1s as long as they don't pay dividends to their shareholders, then I think you need to look out if you're investing in weaker banks, like for example Deutsche, or the banks that have a weaker balance sheet and also a weaker profitability. But for most of the banks that you mentioned, like UBS, CS, at this juncture, I see the risk of that happening. At least voluntarily, I think is very low, unless for whatever reason, let's say the regulators ask them to do that to preserve capital. But at this juncture, I don't see that as our base case. See, the next question is Asian high yield or US high yield? Which one is better in my opinion? If you ask me this question at early to middle March, I would say both are looking very, very attractive. But right now, I think Asian is a lot more attractive for a couple of reasons. First, last month, the US Fed has announced that they will be including corporate bonds as well as fallen angels in their asset purchase program. That means they'll be buying bonds of companies that was previously investment grade, but then recently downgraded to high yield. So the immediate effect of that announcement was we have seen a very strong rally in the high yield bonds. I think before the announcement, it was trading at a similar level. That means credit spreads was 10+%. After the announcement, last check, it was at about 700 bips. That means the spread was around 7%. So there's a very strong rally, and I think the momentum is likely going to be sustained. But I'm personally skeptical to this decision because I think it will have long-term negative repercussions for the US high yield market, because I think it will encourage investors and also borrowers to take on riskier behaviors when times return to normal. Because now that everyone knows that we actually have the Fed backstopping losses when bad times hit, that naturally means that a lot more borrowers will take on higher leverage, and a lot more investors will be going for higher yield when the dust settles, which I think is bad for the market long term. And comparatively, Asian high yield, even with the past couple of weeks of rally, I think the valuations are still looking a lot more attractive. Is it better? I think the next question is roughly similar. Is it better to buy USD bonds of US-based corporates because the US Fed will potentially build them out as per recent policy response? I don't think the US Fed will directly build out the corporates, but what they have successfully done is that when they announce they'll buy corporate bonds and also foreign angels, that gives that immediately send a lot of funders or investors, like let's say the investors who are previously standing on the sidelines, they are afraid to lend, they are afraid to invest. That announcement immediately bring them back to the market. So we have seen right after the issuance, US issuance, if you look at US new bond issuance, the volume is a lot more higher than Asia. So what this means is that risk sentiment in the US market is a lot more stronger. So if you're looking for momentum, I guess that's the place to be, because I think the momentum will sustain for unless the COVID-19 pandemic worsen from here, which is not a best case. But I think if that's not the case, then I think the momentum in the US higher market will be sustained. But as I mentioned earlier, I think the long-term fundamentals and then the valuations, I think, is looking more attractive for the Asian side. That's so far the last question on the list. So I'll wait for maybe 5 more minutes before we close off Q&A. Okay, I just see a new question coming, asking about my view on Treasury yield, specifically 10-year. I think in the short term, that means the next 2 to 3 years, I think the economy will see a gradual recovery. I don't foresee a very sharp recovery in economic activity. So what that means, if my thinking is correct, is that we don't foresee central banks tightening their policy measures significantly and sharply. So I expect yields to stay low. And but the longer term picture is that with so much money printing going around globally, especially the US, and then so the longer term implications is that with the productivity not raised, but at the same time a lot of money printing, I think inflation will go up in the medium to longer term. But that means yield should go up to reflect higher inflation in the longer term. But in the short run, because of the weak economy, I don't expect yields to go up in the foreseeable future.
All right, I think that's the last question for tonight. I want to thank Chung Yuh for his informative sharing tonight, as well as all of your participation in asking questions. Okay, if you all have further questions regarding tonight's presentation or with regards to how you can get started at IGM, feel free to talk to your IGM advisor or contact us via the email at enquiries@ifastgm.com or call us at this number over here. Okay, so I just want to thank everyone for tonight's participation. And yeah, this will be the end of this webinar. Thank you.
Thanks again for joining us.